Auto Trader Group shares sat at 515p on Friday, as three separate brokers cut their price targets in a single session, with RBC Capital Markets slashing its target from 830p to 535p, a cut of more than a third. The curious part is not the downgrades themselves, but the stillness in the share price. When three analysts in one day conclude the re-rating story is broken, the absence of panic selling is its own signal. Deal Builder was the product at the center of Auto Trader's premium story. The platform was designed to pull committed, purchase-ready buyers into dealer forecourts, streamlining the sales process so dealers would pay more for each customer relationship. Instead, a survey by the Independent Motor Dealer Association found that many dealers had already canceled or reduced their packages with Auto Trader, citing a loss of control over the sales process and concerns about lead quality. The tool meant to justify higher prices is the tool dealers are walking away from. The question this creates is not simply whether Auto Trader's revenue will be lower than expected in FY27. It is whether the entire valuation logic, which rested on average revenue per retailer growing as digital adoption deepened, can survive a reversal in that adoption. That is a different problem from a product teething issue, and it is the question the brokers are now pricing differently from one another. Berenberg's revised estimate is the most precise statement of the damage. The broker now expects average revenue per retailer growth of just 5.2% over FY27, down from its prior forecast of 7.5% and below the consensus estimate of 7.8%. The gap is material because Deal Builder was built into the April 1 pricing event, the annual moment when Auto Trader raises package prices across its dealer base. If dealers have already canceled or downgraded their packages, the pricing event becomes a negotiation from weakness, not a renewal from strength. This is the buried assumption the consensus treated as settled, that dealers who found value in digital tools would naturally upgrade to higher-tier packages over time, driving ARPR expansion without requiring Auto Trader to continually justify each price step. That assumption required dealer satisfaction. The Independent Motor Dealer Association survey broke the assumption at its foundation, not because digital tools have failed broadly, but because this specific implementation gave dealers less control over their pipeline. And in a market where EV stock is already selling faster, margins are already tight. Dealers exit when the product costs more than it returns, and that exit makes the re-rating harder to achieve, which makes further exit more rational. RBC identified a second mechanism compounding the first. Fast vehicle sales, particularly electric vehicles selling approximately 1 week faster than a year earlier, reduce dealer incentive to pay for premium listing products. When stock moves quickly, dealers have less pressure to spend on tools that accelerate lead conversion. RBC noted that overall stock turnover remained around 30 days, but the EV segment's faster clearance rate is precisely where premium products should generate the highest returns. Instead, it is the segment where dealers see the least justification for the cost. Auto Trader's exposure to this structural headwind is not transient. It reflects the same directional shift that made Deal Builder's adoption case harder to sell to dealers in the first place.
Berenberg and JP Morgan both cite Deal Builder as the primary risk, but they arrive at different conclusions about what it means for the share price. Berenberg's hold at a 665p target implies a 29% recovery from the current 515p, with the thesis that the shares already trade at a 25% discount to their 3-year average PE of 22x, and that once Auto Trader delivers earnings upgrades, the discount closes. JP Morgan's underweight at current prices implies no meaningful upside without evidence of execution recovery. The divergence is not about facts, it is about which condition must confirm before the discount is safe to buy. For a holder, the immediate question is whether the April 1st FY27 pricing event can still land with sufficient dealer retention to support ARPR growth above 5%. If renewal rates recover and the Independent Motor Dealer Association survey proves to have captured a concentrated cluster of dissatisfied dealers rather than broad attrition, the 16.7x PE discount versus the 22x historical average becomes a genuine entry point. If the April data confirms that cancellations are spreading across the dealer base, reducing the number of paying relationships before the price increase can apply, then RBC's 535p target, rather than Berenberg's 665p, reflects the realistic floor. The April 1st pricing event is the earliest checkable variable that resolves the ambiguity. It prints before the next full earnings release and directly measures whether dealer retention is stabilizing or deteriorating.